We are in a historic day only because we can declare that the debt deal is officially done. We lifted the debt ceiling, and that means all problems have been solved. Welcome to new subscribers. Couple of housekeeping items. There is a video called How to Navigate the Channel, and there is a roadmap, which is a playlist that walks you sequentially through it from a beginner who may not know anything about bond investing. So check it out. My usual disclaimers in every episode: I am not here to give you investment advice. I am sharing my education. You make the decisions. I am not a wealth management advisor. I do not have any sponsors. I am not here to preach any product or politics. I thought through today's episode. We are looking at the day after the deal, so to speak. I thought we'd draw some parallels from what happened right after the debt ceiling was increased in 2011. And there was a different kind of situation in 2019, which also has parallels with where we are today. And then step back and say, what does it mean for the next couple of weeks? And what does it mean for the next few months? All said and done, we have a deal. The left did not get everything it wanted. The right did not get everything it wanted. And I'm told we all won because the country came together. Yay. Well, where do we go after that? You may remember the original thought was that this wasn't the highly predicted solution. There was always an element of doubt. Nobody thought things would go to a crash and burn, but there was a lot of talk about a band-aid solution, and I will say it's impressive that people can come together for a non-band-aid solution, not create some kind of a pinata to hit again and again next year and drag it on. So the fact that it is past the next presidential election, kudos. It is done well by both parties, and at least we don't have to be talking about this for another couple of years. So I thought we'd take this moment to discuss what the history of debt in the US has been. And the idea that debt is new to the country is obviously not real. We've always had trillions of dollars of debt. It didn't register in the trillions when the country was originally founded by the folks who came here from England in the 1770s. We'll actually look at something all the way back and learn how debt financed growth and what the positives and what the negatives are. And in terms of debt held by public that registered in trillions, we've had some of that even from the 1940s. It's just that the rate has gone astronomically higher. And here is the stunning part. This only takes us up to 2019. And by 2023, we have doubled where we were at 2019. And all of us know that the pandemic vastly increased debt because the government had to step in and do its thing. And this is again not about politics, but we are here. This is today. We have 30 trillion plus in debt. The real question I would submit is not what the dollar amount of the debt is, but what did incurring debt give us back? Let me explain more. To be precise, what we are going to be measuring is, did the addition of debt add to the GDP? And that is really the story to look at. So if we went all the way to the first few years of the country, the US was indebted to France. The US had to borrow from other countries. And that borrowing is what positioned the country to lay out the initial infrastructure. Now, let's be real. There was slavery, there was all kinds of stuff that went on. So the cost of labor was artificially deflated. So GDP was higher. And so the country progressed from 1790 all the way until the Civil War by paying off its debt and growing astronomically, which is amazing for a new country. And and I know what happened in 1860, the Civil War. Well, how do you fund the Civil War? It was through debt. And while the war was happening, our productivity declined, and so our debt goes up, productivity or GDP goes down, so the debt to GDP ratio becomes terrible. If somebody was looking at the country the day after the Civil War, they would say, oh my God, what have we done? Our debt to GDP ratio is up to 40. How are we going to pay this off? Well, place at the right time, and it also helps that the Union Army, which won the Civil War, also had the resources to plow into development of the entire country. And so for the next several years, precisely for the next 60, 70 years, there was unfettered capitalism. There really was a whole bunch of monopolies, and you know, and I know that, the Carnegies of the world and so on. And these kinds of monopolies, again, with depressed labor conditions and the fact that they could extract as much profit as they possibly wanted, what happens again? You have your costs in a downward pressure. You have the corporations going very, very fast, and the country is able to pay off its debt. So one would say post-Civil War, the growth has come at a tremendous return on investment in the sense that incurring the debt set the country up to a great growth spurt, and the growth spurt enabled us to get out of debt. What happened in 1915? Short memory, World War One. And so we again had to raise a ton of debt to go into World War One. It's good to be on the winning side of a war. So the US, along with the Allies, won World War One. The Treaty of Versailles, some would argue, was set up in an extremely biased manner, and that created the problems that led to World War Two. Nevertheless, the US was the creditor during World War One, and it got huge returns from World War One, and it was able to pay off a lot of its debt and still grow at a strong phase during the 1920s and the 30s. And right as it entered the late 20s into the 30s, what happened? Another debt event, the Great Depression. Well, how do we claw out of the depression? We assume a lot of debt, a lot of federal programs. The reason I'm walking you through all of this is debt as a solution to dig us out of trouble is not new. So the Great Depression also had a lot of debt, and the idea was that we were going to grow after the Great Depression at a tremendous rate and pay off. That plan worked beautifully for about a few years, and then World War II. It's World War II, again through war bonds, and we incurred astoundingly high debt. Part of the reason is because the working men of the US, and there were obviously some working women who participated, but that was not until much later. So you take out the workforce and you deploy them towards war, your GDP drops. You raise debt, then your debt as a percentage of GDP rockets up. Once again, you're the lucky one if you're on the winning side of the war. The US had a commanding position at the end of World War II. We were the financiers of the world. Our debt gets paid back. We acquire new territories. There are new trade deals. And all of this led to, again, phenomenal economic boom. And so at the end of World War II, if you were to sit here and say, is debt good? Frankly, you would say, well, we've always found a way to dig out of debt, so maybe it's not that bad. Well, what happened in the 80s? We had the oil price crisis. All of a sudden, we were the buyer of oil. Oil came from the Gulf. The Gulf increased oil. There was a lot of inflation. How do we dig out of that? We're in serious debt. We dug out of it through this little thing called the internet. To 2000, sorry, the year 2000, the US had the dot-com boom. We had a technology that the rest of the world wanted. Our productivity was significantly higher. Our exports are higher. So we were clawing out of the 1980s fiscal debacle with the 1990s scenario of astronomical growth. And so our GDP was growing so fast that debt as a percentage of GDP actually started coming down. We actually had a fiscal surplus for the last time right around that period. What happened in 9/11, 2001? Obviously, it caused an economic collapse for a duration. And then we clawed out of that economic collapse only to go into a financial crisis in 2008. If you were the government, you sat there and said, what do we need to do to come out of crisis? You're going to follow what worked before and say, let's get into debt. And at the end of 2008, we threw a lot of debt at the problem and said, I think we can come out of this. GDP did not grow nearly as fast after 2008, given the amount of debt that was added. So debt to GDP kind of stayed at that same level until this other little thing happened, which is COVID. Once COVID threw even more debt at the problem, And right now, we are even edging north of that. The moral of the story is debt by itself is not the issue. We've always had increased debt, but we need to have, hopefully not winning another war, but we need to have innovation. Perhaps it's the internet. Perhaps it's infrastructure. Maybe it is AI. Nobody knows. Maybe it's new kind of energy sources. Just like the dot-com side of the world delivered something that the US had that the rest of the world did not have, we need to create a way by which GDP grows faster than debt. Innovation propels us forward and we're able to pay off debt. That is what breaks the cycle, hopefully not winning wars and hopefully not putting us in a position where the only way out is to destroy other things in order to win. But there is a story here. The innovation after the Civil War and the dot-com boom are indeed constructive ways to decrease the debt to GDP ratio, and we can only hope that our generation or the next generation get there. So if the US Treasury was a family, all that was done right now is we increased the credit limit on the credit card. We have not figured out how to not shop as much given our income. In other words, the debt to GDP side needs work. And we have some history of how we can do it. And that means we need to do something else right now. Using that same family analogy, people are going out and shopping every day. When they shop, their credit limit was almost reached. We just bumped up the credit limit. That means we need to go issue a ton of treasuries. When I say a ton of treasuries, right now the limit of spending is only 30 billion. We came very, very close to defaulting. We are used to spending a trillion, a cool trillion. Where is that money going to come from? That treasury bills that are issued between now and the end of 2023. You, I, and several other institutions will buy those treasury bills, and so expect a flood of treasury bills coming our way. Treasury bills, and there is episode 39. I'm going to post the link to episode 39 one more time here. That talked about how the treasury auction works. And there's a reason I'm bringing that up, because when there is a ton of new debt that's coming in, it's fun to participate in the auction. And by fun, I mean higher yield, and I'll tell you why. You may remember how a treasury auction works. And we talked about Samantha, and Samantha says, I don't want to be picky. I don't even want to tell you the exact price at which I need to acquire debt. All I want is to buy $5,000 of treasuries at whatever price the market sets. Thank you. And the government says, I love people like you, Sabrina. I'm going to take your 5,000 and I need some more money. And if the answer is you need some more money, then the government says, okay, who else is willing to pay me? And the first priced round, so to speak, is Bob. Bob says, well, I'll put in another 50, meaning 5,000 bucks, but I need 4.91%. If the US government only needed to raise 10,000 bucks, the US government will say, I am done. I'm going to take the cheapest bid and I'm going to roll Sabrina into it, and we are done. Well, maybe the government needs to buy more than 10,000 or issue more than 10,000 in debt, and we made up the number that we need 25K. And so what the government then says is, okay, I ate up the 5,000 and now I need to go to the next highest bidder, and that's Mike. And Mike wants 4.51%. Gee, I wish I didn't have to pay more, but because I need 25K and so far I'm only at 10K, I'm going to accept Mike as well and pay 4.51, except this only gets me to 20. Who's behind Mike? Jane. Jane is a smart lender. Jane wants 4.52%. My hands are tied as the government. I still need 25K. I'm not going to decrease that amount. So I'm going to take 5K from Jane at 4.52, and the government isn't going back to Mike and saying, hey, don't tell anybody I paid Jane 4.52. I'm only going to pay you 4.51 because Mike, Bob, and Sabrina will be upset. And Carla is the only one we're going to turn away because Carla wants 4.53. and the government only wants 25K. And so the government says, Carla, you were too greedy. I'm not going to take anything from you. Jane, you are lucky. You wanted 4.52. I'm going to take 5K from you. So what the government then does to not make Mike, Bob, and Sabrina upset is they go back and pay 4.52. Here is the reason why I'm reviewing all of this. Government builds up its buffer from 30 billion to a trillion or even north of a trillion, there will be more and more bills that will come to market. And if you participate in the auction as the Sabrina in the story, your yield will be higher because the government will have to dig deeper and deeper to take the next higher bidder. So participating in auctions might be a very, very nice thing to do in the short run. What are other things we can take from 2011 and 2019? The very first thing that everybody is aware of is when that trillion, 1.1 trillion, what's 100 million, 100 billion among friends, when that 1 trillion-ish is being issued as treasury bills, you, I, and several others are going to rush to buy them. That means the money we would have spent somewhere else is going to be spent on treasury bills. What are some of these somewhere else's we might have spent? Maybe we would have said I was going to buy a house. Yeah, no, not going to do that. Maybe we're going to buy stock. Nope, not going to do that. All of those will cause what is called the liquidity crunch, and it creates strange behaviors. In September 2019, something very strange happened. Check this out. EFFR means effective federal funds rate. The EFFR went up by almost 1% for one day. That was the first auction after the debt ceiling was raised. So many people profited because the government suddenly needed a huge amount of cash, and they went deeper and deeper into the auction pool. And SOFR or SOFR is the overnight funds rate for banks. EFFR is the effective federal funds rate. Bottom line is, right after the debt ceiling is raised, be on the auction line. And if you are the Sabrina, meaning if you aren't a priced participant, hopefully you will see a couple of interesting things happen there. So one that happened in September 2019 was that corporate tax remittance was lower. As a matter of fact, Secretary Yellen has talked about lower corporate tax collections now. We know that there is a huge volume of treasuries coming, so a lot of interesting things happening there. Couple of other things from September 2019, the raising the trillion. There's a very good Goldman Sachs paper. I posted the link here. Is that 1 trillion is going to come from somewhere, and money market funds are where they think it is going to come. Money market funds today pay 5.02%. So if you're a bank, you're going to say, yeah, it's too much work for me to take the money out of the money market funds and not issue loans against that as a reserve. So you better pay me a very nice premium or I'm just not going to buy it. What this means is new bills will need to be cheaper, meaning new bills will need to offer an even higher yield over the next few weeks to months. Therefore, what does it mean for the next 3 to 4 weeks? The 0 to 1 month yield nerd idea is to hang out in the primary auctions, not in the secondary market. I mean, you get a slightly lower yield, but hang out in the primary auctions and think about, and you do you, this is what I'm thinking of doing. I'm thinking of taking a portion of my treasury portfolio and putting it in auto rollover. So I don't even have to think. So it automatically goes in 1 month treasuries or 3 month treasuries or so on. You would still get the coupon or the discount. So if you bought $500 for 495, the 495 becomes 500, and now you get to invest the $500 and possibly own 505 or so on and so forth. So think about that. The idea for me is to still have a lot of short-term securities until there is a very clear sign that the federal funds rate is going to drop. And there is still a possibility that the liquidity crunch of everybody chasing that $1.1 trillion in high quality bonds is going to create some tremors within equities. And I'm patient. Patience is a virtue. And what a wonderful thing that you can wait at 5.5% plus state tax while being patient. So suits me to wait. What does it mean for the next 6 months? The next 3 to 6 month plan, I'm in no hurry to jump, but right now there are non-callable agency bonds. They pay about 4%. Remember, if you buy the right ones, FFCB, FHLB, you also don't pay state tax. So it's about 4.25%. If the federal funds rate go up, most likely those will also go up, and you can lock in 4.5% for the next 3 years, 5 years before interest rate drops, and that's pretty good. Um, Corporate bonds, it's taxable, so we literally need to play our yield Super Bowl game. I'm in no hurry to play it in the next month, but eventually we'll go back and look at all the types for all the durations. But there's probably some there in a month, 2 months, if they pay a nice premium above, you may want to lock again a higher, coupon for a longer duration, but not right away. So if you can just be patient, even though we are grasshoppers, there is plenty of good things coming. The main thing to remember is just because there was a bill passed to increase the debt ceiling, no problem was really solved. Inflation needs to be tamed. There needs to be more clarity on interest rates. The best next step, in my opinion, is still short-term treasuries, and we just need to be patient and wait. If you have any questions, I'm glad to answer it. Yieldnerd@gmail.com. Thank you and have a nice day.